Accounting Fundamentals, Problem 3. A business had the following 6 transactions between March 1st and March 6th. On March 1st, business received $10,000 from owner Lemon. The business gave capital to Lemon. March 2nd, paid the first month's rent of $1,000. March 3rd, purchased equipment by paying $4,000 cash and executing a note payable for $5,000. March 4th, purchased office supplies for $700. March 5th, billed client for $11,000 of design services completed. March 6th, received $7,500 on account for services previously recorded. What is the balance in cash at the end of March 6th? This question is focusing on cash. The balance in cash considering these 6 transactions. Now, one thing I want to note, this is a very important question, and the reason why is because if there's one specific account that a professor or an exam or is very important in practice in determining, it's the cash account. And that's because it's the most frequently used in terms of, you look at various transactions, most frequently used out there affected. So what we're going to do here is we're going to go through these 6 transactions. We're going to look at the accounting equation. Now, again, the question is only asking what is the balance at the end. So we're just going to focus really in terms of the end answer on what is the balance in cash at the end of these 6 transactions. But to best do this and help you understand, go through the process of how to learn to do this, we are going to use the accounting equation. So I'm going to note how much each transaction goes up or down or no effect at all by cash, but it will also say, and you can write these down in the notes. Of course, I'm going to say how exactly this transaction affects the accounting equation, the horizontal approach I like to use when I go through these things, so it helps you understand. That way you can get a good idea of how to analyze transactions to basically determine the balance for all these different types of accounts. March 1st is the first transaction. Business received $10,000 from owner Lemon. The business gave capital to Lemon. All right. When you're thinking about this, first thing, remember, we're solving for cash. So ask, are there any inflows of cash here or any outflows? Well, one thing to note is it just says business received $10,000. And the question does not say specifically, it does not use the word cash. Now, on my problems, on other professors, on exams, whatever you're looking at, if you're not told what a dollar amount is, it's assumed to be cash. For everything else, you have to be told. You have to be told $10,000 of inventory, $10,000 of building, $10,000 of notes payable, whatever it is. You have to be told if it's blank, if it's just $10,000, it's assumed to be $10,000 cash. So that's what we have here. Business received $10,000 of cash from owner Lemon. The business gave capital to Lemon. So thinking about the accounting equation, where the business is receiving, and this is one thing to note, is that remember, in accounting, we use the business entity concept, which keeps the owner's books and the business's books separate. So we're just focusing on the business here in these transactions, not our owner Lemon, in doing the books, doing the recording. So business received $10,000 cash from owner Lemon. So that means our business cash goes up. It increases by $10,000. Well, again, we're focusing on the accounting equation. So if an asset, which is cash, goes up by $10,000, we have to have a corresponding increase on the other side. Liabilities go up? No. Equity? Yes. Think about the owner's equity, WIRE, W-I-R-E, withdrawals, investments, revenue, expenses. Those are the 4 adjustments for owner's equity. So here, when the business gives capital to Lemon, this is an investment, which increases owner's equity. It increases owner's equity, so we have an increase of assets, increase of equity by $10,000, so it balances. Go on to the next date, March 2nd. Paid the first month's rent of $1,000. So the idea here is you're looking for inflows or outflows. Is this an outflow of cash? Well, it's $1,000 of implied cash because it's not told, so it's cash. So cash is going down, decreases by $1,000. The other side of the equation, right? Assets go down by $1,000. This is going to be equity goes down by $1,000 because the E in WIRE is expenses, and expenses decrease owner's equity. So this is going to be rent expense. So that is March 2nd. March 3rd, purchased equipment by paying $4,000 cash. Look right there. Decrease $4,000 cash. That's clear as day, right? $4,000. And executing a note payable for $5,000. Before we jump on to the next one, let's just think about the accounting equation. So Do we have any inflows of assets here or increases in assets? Yes. We purchased equipment. So equipment is going up, is an asset that's going up. We do also have a corresponding decrease in an asset by paying $4,000 cash because cash goes down, which is an asset. So equipment goes up, cash goes down by $4,000. So we have a corresponding increase and decrease in assets, but it's not equal. And then the other side, liabilities and note payable goes up by $5,000. So if you think about everything, the equipment is being purchased at historical cost, the amount paid, which is $9,000. The $4,000 cash plus the $5,000 liability owed, $9,000. So assets go up by $9,000, cash goes down by $4,000, liabilities go up by $5,000, and the equation balances. Okay, next one. We have March 4th. Purchased office supplies for $700. So just like we saw in March 2nd, we paid first month's rent. Here we're purchasing office supplies. So this is a decrease in cash of $700. Now here it's assets go up by supplies of $700, and then we're going to have assets go down by $700. So assets go up, assets go down by the same amount. So we're done with March 4th. March 5th, bill client for $11,000 of design services completed. So does this transaction have any effect on cash? Well, let's think about it. What assets go up here? Accounts receivable. We're not receiving any money. We're just billing the client. We're saying, hey, client, you owe us money in the future. Accounts receivable is recorded, goes up by $11,000. Do we have a corresponding increase on the other side? Yes. We have an increase in revenue of $11,000, which revenue increases our increases our owner's equity. So right there, we have accounts receivable goes up by $11,000, owner's equity goes up by $11,000, the accounting equation balances, and there is no effect. No effect. I'm going to put a 0 with respect to cash. Okay, our final transaction, March 6th, received $7,500 on account for services previously recorded. So remember, if there's nothing after, then it's assumed to be cash. Now, there are some exceptions. Like you saw March 5th. I should have talked about this earlier, but caught myself. Got to go back. This is an accounting. Got to be careful. We haven't given our final answer, right? Is this your final answer? No. In March 5th, it said bill client for $11,000 of design services. Note, there's nothing after. And I told you, hey, if there's nothing after, it's assumed to be cash. Well, it is. It's $11,000 of cash. But the key is that it says bill client, which means that we're not yet getting money from the client, so there's no recording of cash, inflow or outflow, but the client will have to pay us cash in the future, and the right to cash in the future is called accounts receivable. So see, it is cash, it's just bill client, you got to pay attention to that language. That's really crucial. On March 6th, received $7,500 cash, again applied, on account for services previously recorded. So what's going on here? We previously already had the transaction for the March 5th. And what this is saying is that, hey, assuming, let's just say the business just started on March 1st. The March 5th transaction where we billed, some of the clients are now paying off what they owe. So we're receiving $7,500 cash on account, which means it was on accounts receivable. We are getting $7,500 of cash on account. We increase our cash by $7,500. Think about the accounting equation. Cash goes up by $7,500 because we've already recorded the accounts receivable, which was this transaction here. Assume that these 6 transactions are the first the business ever had. That means the accounts receivable was already recorded on March 5th, which remember, there was no cash on March 5th. Again, on March 6th, the accounting equation, cash goes up by $7,500, which is an asset. Accounts receivable goes down by $7,500, which is an asset. The accounting equation balances. We have gone through all 6. We then tally up all these items from the 6 transactions, and we calculate the final balance of cash at the end of March 6th, which is $11,800.